Good afternoon, everyone. And today I'm chatting with Ronald Stöferle. Now, Ronald is a guy who has been analyzing the gold world with his report called In Gold We Trust since 2007. In today's interview, we discuss the current state of the gold market, how Trump is impacting the flows for precious metals, and we get into some price targets that Ronald has put into his report and why he thinks that gold could be heading there. All right, everybody, enjoy the interview. Ronald, thanks for joining us.
Hi, Steve. Pleasure.
So this is the first time we have had an opportunity to chat. I know I met you at VRIC a couple of years ago, but I figured it'd be a great time to have you on because gold has had quite the 12 months, we can put it that way. What's going through your head right now when you think about the gold market? Why is it moving? What's got you kind of excited when you look at the recent action?
Well, the interesting thing is it just doesn't really want to come down. I mean, let's not forget, Steve, that at the beginning of the year, gold was trading at 2,600. Um, let's not forget that 1 year ago, gold was trading at 2,300. So this has been a massive move. So it just really doesn't want to correct or consolidate any lower, which is telling me that there's quite a lot of interest waiting on the sidelines. People are buying the dip, and I think this is primarily Western financial investors that completely missed the gold train over the last couple of months. Um, they are buying every dip, and what's very encouraging is the fact that gold was trading at 3,500 a couple of weeks ago. Obviously, it has corrected slightly, but during that process, sentiment completely cooled off, and it's even in very bearish territory now. Commitment of traders report has improved, so definitely less speculation, which is a very, very positive sign. So from my point of view, perhaps the next couple of days, couple of weeks will be somewhat of a sideways trading. The seasonals are not really supportive, but I think that we will definitely see by the third or fourth quarter of this year new all-time highs.
So you recently put out a lengthy report. My understanding is you put these out annually, and they've become pretty popular within the gold bug community. One of the things you refer to is the Trump shock. What's the high level for those who haven't had a chance to read the report?
Well, yeah, I mean it's a massive report again. It's 450 pages. We're publishing it for 19 years in a row now, and it's probably the most widely followed publication of these days. A report is published in German, English, for the very first time in Japanese, in Spanish, and also in Mandarin. So we really try to analyze everything that's going on in the world, in the gold world, which is actually quite a lot. Because if you want to understand gold, you have to basically analyze everything. It's geopolitics, it's opportunity cost, it's financial markets, it's inflation, it's the economy, it's investor sentiment. So yeah, and then every year we end up with more than 400 pages. So um, the Trump shock. I think it's just a massive realignment that we're seeing. Donald Trump and his administration, I think they are aware of the so-called Triffin dilemma. They are aware of the fact that um, um, being the issuer of the world reserve currency has effects on the economy, has effects on obviously manufacturing, and I think they kind of want to tackle those issues. First of all, I think Donald Trump wants and he needs a significantly weaker US dollar, which is one of our key takeaways for the next couple of quarters. The second thing is that uh, not only he, but I think slightly smarter people like Scott Bess and Stephen Mirren, Howard Lutnick, they are actually openly discussing a so-called Mar-a-Lago Accord, which would be pretty similar to the Plaza Accord meetings in the 1980s and the Louvre Accord afterwards, which would basically be some sort of a realignment of the monetary infrastructure, leading to a weaker US dollar. And they want to achieve that with sticks and carrots, as they call it. So um, the fact that the US is having chronic trade deficits, that they're experiencing a industrialization. They want to tackle that with new tariff policies. They want to reverse it and boost U.S. Reindustrialization, favoring a weak U.S. dollar. So this is really key. And stuff like gold-backed bonds, stuff like a revaluation of U.S. gold reserves that are still in the books at $42 per ounce. All those things, they were discussed perhaps in the gold bug community, but now they have become center stage. So I think at some point, gold will really stage a big comeback as a neutral monetary reserve asset, and therefore it's not a coincidence that basically every central bank in emerging markets is hoarding physical gold like a squirrel, basically. That we're seeing gold purchases by central banks above 1,000 tons for 3 years in a row now. So I think some sort of a monetary realignment is going to happen over the next couple of months, and I think that gold will play a major role in that.
So something I think a lot about Ronald is, at least lately, just sort of thinking about how Moody's recently downgraded the US. That was their last AAA status. It's gone. Then we think about what's going to happen with these tariffs, and it doesn't take a rocket scientist to figure this out. There's prices are going to go up. A bunch of industries are going to be hurt. It's going to put the US into a severe recession, and they're going to print a ton of money to try to paper over the problems, as the US government has always done, and it's been particularly stronger ever since Ben Bernanke first said the words quantitative easing. And I think that when I think about all those issues that the US dollar has been having, I think about counterparty risk. And to me, that is the brilliance of gold. If I own a gold bar, where's my counterparty risk? What is it? Like Seabridge might get their gold project in the Golden Triangle up and running. Well, that's a low grade project, and it's going to take decades and decades to mine. And we're only talking about 200 million from proven and probable down to inferred. We got the Barrick project in Pakistan, Reko Diq. There's not a lot of these like quality gold projects in the world. I think that there's something like 5.7 billion ounces of gold above ground in the world. That number's off the top of my head. But we're looking at, the top gold projects combined in the world might add a few 100 million ounces to that. It's not significant. So there's not like this counterparty risk where all of a sudden we're just going to see, you know, uh, a, a doubling of the gold supply. That like if every development stage gold project went into production, it might account for like an increase of like, I don't know, 10 to 20% in overall gold supply. So, anyways, that rant being said, how important is that counterparty risk when we think about the value of gold?
Well, it's central, and what you describe is basically the so-called stock to flow ratio, where gold has a very high stock to flow ratio, which is basically the inverse, means that and the gold supply inflation is very low, and we crunch the numbers since the year 1900. There's 1.5% inflation, annual inflation in gold supply every year. So basically, if you own an ounce of gold, every year there's like 1.5% more gold being mined, and this number is very, very stable. So Bitcoin, gold has a extremely high stock to flow ratio, and actually Bitcoin now has an even higher stock to flow ratio, and this is what really differentiates gold as a monetary asset to commodities like copper or oil or whatever, that have a very low stock to flow ratio. Now, when it comes to counterparty risk, I think we're seeing some sort of a bear market in trust. We once wrote a report called Gold and the Erosion of Trust. Well, we actually said back then already that there's an erosion of trust, not only in finance, but also in the society in general. People don't trust in institutions, science, obviously, politics. And I think that gold is some sort of a mirror to that development because, as you rightly said, gold is 100% possession without any strings attached. And that's really the beauty of gold as long as you hold it in a physical form. If you're talking mining stocks, for example, that's a completely different risk set because everything that can go wrong in a mining project will go wrong at some point. And you've got equity market risks, you've got management risk, you've got geological risk, you've financial risks, infrastructure, First Nations, whatever. So I think that's always this is why we differentiate between what we call safe haven gold, which is physical gold, and then on the other hand, what we call performance gold. This is primarily silver and mining stocks. So therefore, I think as long as we're seeing this erosion of trust, there's a very, very strong case for gold being made. And as I've said, this mirror is telling us basically that there is globally now an erosion of trust that will probably or unfortunately continue.
So you've been publishing your report since 2007. How much has sentiment changed over that time? Is the conversation amongst the gold bug community sort of the same? Like, what have you noticed that's changed within the narrative of gold from 2007 to 2025?
Well, that's a great question, Steve. When I published my first In Gold We Trust report, I was still a young analyst working for a bank. Um, I think the first couple of reports were pretty basic because nobody actually teaches monetary history. Nobody really teaches on university or in school anything about sound money, the Austrian school of economics and so on. So during my writing, I actually discovered all those topics and actually took the red pill basically. And I think the discussions that I had since then were, I've often heard back then when gold was trading at 600, yeah, but it doesn't pay any interest and you cannot eat gold and it's an unproductive asset. And I'm still hearing similar arguments. And I think the major difference between now and back then is that this bull market is clearly driven by emerging market demand. And I think that people often forget it because gold is often being marketed as a, let's say, a catastrophe hedge, something that goes up when everything else goes to hell. But actually, there's a very positive case for gold being made. Gold is a low beta emerging market asset, and the majority of demand is nowadays coming from emerging markets. I'm traveling to I was in Saudi Arabia in January. I traveled to Turkey quite often. I'm in Dubai, in the Mid East, in China, in India. And if you go there, if you talk to people, if you just walk around, you can tell that gold has a much higher importance for people there. And with the growing economy and higher savings rates, there's some sort of a natural tailwind from those countries that actually prefer real physical gold. So basically, two-thirds of the gold demand is coming now from emerging markets, and that's a big difference compared to 2007 when I wrote my very first In Gold We Trust report.
Something that we don't really talk about much because it sort of seems like it's not the most exciting topic, but I'm curious what your thoughts on this are because I can't really wrap my head around it. But Basel 3, how big of an impact does this have on the overall gold market?
Um, I think it's not going to have a big impact. I think people kind of mix up the topic of HQLA and tier one asset as well as tier one capital. So it's a little bit technical, but Steve, I talked to many bankers all over the globe. What's going to happen on July 1st, and I can tell you for treasury guy sitting at the trading desk of a bank, for an asset liability manager, for an investment banker, um, actually they couldn't care less about gold. It's just not, just not something that they're really interested in. So I think this is heavily kind of overemphasized in the gold world. So from my point of view, and that's probably quite an unpopular opinion, from my point of view, it's quite a non-event.
Okay. Um, Now I know that you put your neck on the chopping block a little bit when it comes to your report in the terms of price targets. You do throw some out. Let's get into that. Where do you see the price of gold going, either base case or that sort of particularly uh, bullish case for gold?
Yeah, well, we published in 2020. We made a long-term analysis, and said this is going to be a golden decade. We were quite ridiculed back then. I would say people didn't really take us serious, because we said at the end of this decade, so in 2030, the price of gold will be trading based on our model, on our monetary model that we also describe in our reports, around 4,800 US dollars. And we're right on track. Actually, we're slightly above that trend at the moment. So we stick to that price target, 4,800 US dollars. However, if a second inflation wave should hit markets, and I wouldn't rule that out, because actually inflation is quite stubborn, and um, I would say that most investors and most central bankers especially think we're going back to the old regime, to the great moderation, where inflation was the least concern. I'm a bit doubtful when it comes to that, and it seems that inflation could make a comeback. So if that's going to happen, we can see significantly higher prices, and based on our inflationary model, we could end up at 8,900 US dollars by the end of this decade. However, I think what's really important, Steve, is I think we're in a bull market. We're not at the very beginning of this bull market, so gold is not a contrarian asset. Gold is not super cheap. In fact, compared to oil, for example, compared to copper, compared to silver, gold is pretty expensive. From a monetary point of view, gold is still very cheap. Valued against equities, gold is also pretty cheap. But I think, in the second half of this, what we call golden decade, our take is that silver, mining stocks, and commodities will actually outperform gold. So gold always goes first, and then with a slight delay, silver, mining stocks, and commodities are catching up. And I think this is really now one of our core views, that you should actually overweight those performance gold assets that are still, quite seen quite pessimistic in markets, because who actually is bullish on silver outside of the silver community? Who's actually bullish on mining stocks? Which generalist investors are nowadays attending mining conferences? And then, if you have a look at the fundamentals of the mining space, there's just free cash flow monsters. They've sold off. They reduced their debt. Their balance sheets are in great shape. We've now seen some really good M&A deals, but we haven't seen any big takeovers by the majors yet. This is gonna happen. We're seeing that silver is in the fifth year of supply deficits, the fifth year in a row. So therefore, I think now is really time to be heavily overweight silver, as well as mining stocks, and also to some degree commodities.
All right. Well, Ronald, thanks very much for hopping on here today. For our audience, if they want more of your commentary, where can they go to?
Well, in goldwetrust.report, that's where you can find our webpage, our report. As I've said, 450 pages. There's also a compact version, because I know that not everybody is keen on reading such a massive report. There's also a slide deck summarizing the key insights of this year's report. And for our asset management company, which is incrementum.li, we manage funds in the commodity space, in the gold space, mining stocks, value strategies. And we also combine gold and Bitcoin in 2 of our funds. Have a look at incrementum.li, and I will make sure to send you some links. Perhaps you can add them to the show notes.
Well, Ronald, thanks very much for hopping on here. And as we continue to see this gold bull market gain momentum, which I personally believe it will, I think that gold's heading higher from here. And I've been long gold ever since 2010, and I continue to believe that it's a put against government insanity, which is what I see more and more today. And it's only going to continue to demonstrate that as we move forward. Hopefully you'll come back on here in the future and we could continue to
Absolutely.
get your analysis on the gold market.
Thank you very much. It's been a pleasure. Take care, Steve. Bye-bye.
All right, everybody. Thank you for watching. If you enjoyed this interview, please smash that like button, subscribe, and ring that notification bell. Guys, also let me know what you think in the comment section. Thanks for watching, everyone.